Welcome back to Don't Chew With Your Mouth Open, a podcast focused on wealth creation and building financial independence in the global south. Today we're addressing a very critical topic, which is navigating uncertainty and dealing with volatility in our markets. This is an important element for most people because in reality, you're never certain about the capital you're building. Having interacted with people who come from very volatile environments, some Zimbabwe, others Venezuela, where a lot of the wealth they created had evaporated because of political instability, environment, economic troubles, and stirring difficult debt situations, and difficult change of government, change of environment, change of political structures, all of which lead to a lot of uncertainty within every environment. We hope today to speak deeply into that, to address the key elements we can within a limited scope. And in future episodes, we'll delve very deep into what uncertainty is, what volatility is, how we should view it as investors, how we should view it as business leaders within our environment, and how the perspective of the globe on us matters in terms of attracting capital. We hope this episode really gives you some tools to help you deal with what we deem as important, the ability to deal with volatility. Let's get into it. Before we get into the strategies, we have to start with what volatility is. What is volatility? It's the amount of change of the pricing of an asset, financial, physical, currencies, commodities, or any sort. That change happens often in our side of the world. There's a drastic change between the top and the bottom, and that happens across our lifetime. Whereas in the developed world, that doesn't happen often. So we face a different reality. Our reality is of change and constant change. Their reality is of constant stability, where volatility causes a deep upheaval, as we saw in 2008, whereas on our end, we deal with a lot of currency volatility. If you just focus on, for example, the rand, we deal with a lot of commodity volatility in price because we are predominantly producers of commodities like oil, and we deal with political volatility where there's consistent change in ideology, in thought patterns, in the future, and how we would deal with that. So the degree of change, the amount of change, that's volatility. We can move from 0 to 100 and 100 to 0 in a very short space of time. Whereas in other parts of the world, that 0 to 100 happens over a long and sustainable pace. And we need to be able to deal with that. So it's important to talk through what volatility is. Why does it affect us? It affects us because it affects how we think about the future. And investment and building the business is all about what you see in the future. What are your thoughts about your customer? Can your customer adapt to you? Can your customer adopt your product? What are your thoughts about the spending power of your customer? How many of them are there and how will they be able to sustain your business model? When you look from the point of an investor, the price changes. Are you able to stomach a large decline or a very large gain? Do you have the capacity to manage that? The inflation, the changing in prices, are you able to sustain yourself through the reduction of your income, through inflationary effects, and tomorrow's rand, dollar, naira, peso being worth less than what it is today? Volatility. It's an important aspect. We all who live in the global south have become accustomed to it. We see it often as a risk in terms of market investment, but it is a strength in terms of our ability to manage changing situations. And it gives us an edge in our investment metrics, in our investment makeup. It also gives us an edge in our business building capacity, where we are able to be nimble, to adjust, and to make the right decisions quickly. The Western world calls that a pivot. We have been pivoting for most of our lives, and we understand what it takes to be great in our environment. But volatility doesn't have to be a bad thing. In fact, for those of us who understand it, as most of us in the global south do, it provides us opportunity. Opportunities to enter into investments and businesses at the right prices when everybody else is not understanding what's happening. Opportunities to sell at prices at which everyone is thinking the business may be worth more than it really is. Those opportunities exist for us to create wealth. So volatility in and of itself is not a bad thing, but let's chat more about it. Let's discuss the strategies around managing uncertainty. The first one, concentrate your forces. Don't go about putting your time and money into things that you don't understand, that you don't have a grasping over, and that you don't have a clear pathway to value creation. Focus on that thing until it becomes something valuable. Once you diversify your opportunities, your time, your money, your risk of capital loss increases. Once you have accumulated the capital, diversity becomes key. But at this point, focus and concentrate your forces. Focus on that thing that you believe can build out your fundamental wealth and value. Oppenheimer's did mining, the Dangote did flour, Strive Masir did telcos. Everybody focused on the one initial thing. Once they conquered that diversification followed after that. And that's when you build on to the next stages of your wealth. Secondly, focus on cash flowing assets. Don't focus on anything that doesn't put money in your pocket. Dividends, rent income, salaries, director fees, whatever it may be, sales and revenue. Focus on businesses where there is a till, where there's money coming in every day that you can see and count. Without cash flow, you will bleed dry. And once you bleed dry, you can no longer survive. Survival in our part of the world is fundamentally determined by how much cash you have in the bank, which leads to the third point. Stay liquid. Always be able to access cash in one way or another. There must always be somewhere you can, whether it's your savings, whether it's access to credit cards, overdrafts, whatever the case may be. Have the ability to stay liquid. One of the fundamental principles that John Maynard Keynes always speaks about is that sometimes when you invest, you must have a great position. But the occasions do happen where you have the great position but don't have the liquidity to sustain it. Then you have to sell out of that investment because you need liquidity. Liquidity is fundamental for us to deal with uncertainty, to deal with volatility, to take advantage of volatility. Liquidity is a cornerstone. Always having access to a pool of money to enable you to go and access that opportunity. We have seen this across the continent of Africa, Asia, Southeast Asia, and all the global south, where people come together to save, to invest, to have access to money to buy resources. It's a key element. Focus on liquidity, focus on cash flowing businesses, and focus your forces on a particular business that you understand that you are able to extract value from. Those three elements are the key strategies for managing volatility. So I want to discuss two foundational principles. The first one is managing your emotions during change and volatility. And the second one is leveraging volatility for your advantage. The first one, change has a drastic impact on your emotional well-being. Whether you're moving homes, you're changing jobs, whether you're changing even your family setup, there's always a difficulty in that. And it's important to learn to manage your emotions. Most of us who grew up in the global south understand that. We have the capacity to manage change and volatility, and we have the capacity to look forward and say, this change, how do I take advantage of it? That's the second principle. Once you've managed to get over the emotional burdens of a high or a low, the second part is seeing the opportunity set. When something goes down, how do you take advantage of that? When something goes up, how do you take advantage of that? We saw it across many spectrums, where during the global financial crisis in 2008, when property prices were dropping, those who were liquid, had cash flow, were able to take advantage of that. where stocks were going to record lows because of market sentiment, emotion. People were able to buy great quality business at discounted prices. When the markets corrected, when the economies corrected, the upward value trajectory was captured by those people who could, one, manage their emotions, and two, take advantage of the volatility. So as we go into further episodes, we'll look at how to see whether an asset is valued correctly, how to think about managing price changes, how to manage our emotions when our investment is going down or when it's going up, and what is the best way to take advantage of these things. These two principles are the cornerstones of managing volatility and uncertainty, and we hope they've helped you.